All right, as we're winding down, so one more week after today, woo! Okay. I'll jump it up and down at the same time, yeah. All right, so we got a couple of little chapters to kind of go through, topics to cover, and then we'll be on to another little quiz. Also, I emailed you guys yesterday to make sure you bring your laptops today, so if you've got those, feel free to go ahead and break those out. You're going to need them here in just a little bit, not right this second, but you can go ahead and get them out and get them ready. All right, so the couple of chapters we have today, this first one of the big things that it sort of deals with, and I've kind of come up with a handful of little calculations for us to kind of go through to kind of represent some of this, are what they're sort of terming as the sort of the keys to successful long-term real estate ownership. Now, most of these, pretty much if not all of them, are kind of common sense, and we've talked about them in one way or another, obviously over the term. But I guess, in looking at these, I mean, is there anything that stands out to you as particularly interesting? I don't think any of them are really surprising. But I mean, is there anything there? I mean, the thing that I thought was kind of interesting from my perspective was, this is the first time I've really seen a textbook author kind of identify these sort of what I would call sort of key success factors. And I think it was a good little list. But, this first one, the whole idea of visionary leadership and the ability to basically sell that vision to others, I mean, that really, in a lot of sense is more of a developer than really an investor. But, I mean, from the perspective of a developer, why is it so important that they can sell their vision?
You have to get buy-in.
Okay, why?
Government,
But beyond government, I mean, but just in general, I mean, so we're saying, okay, you get buy-in from the government, you gotta get buy-in from potential consumers, but I mean, ultimately, what does all that mean? Yep.
So people will like to come to work and be creative.
Okay, all right, what else?
Buy-in for the investor as well.
Okay, to get them to commit to the project, commit to the idea. Because I mean, what is the challenge here? I mean, if you can't get folks to buy in on it, what happens? First of all, the project maybe doesn't get done, or if the project, if you manage to actually get it built, then it's not going to be a situation of build it, they will come. They may not come at all, and then you end up with a failed project. I mean, so what are, I guess, some of these challenges that you face in trying to sell the vision of the project?
You have to let your various stakeholders to accept and be part of whatever venture you're looking to implement.
All right, you've got to get them to be, sort of involved and invested, stakeholders, have something, in the mix. So, like, the kind of example that I like to think of is like with a renovation, sort of, or a sort of a rehab of a particular area of a city. Something like, a Wynwood in Miami, where you're taking basically a derelict, sort of part of the community and turning it into something more vibrant. How does somebody go about igniting that fire to make that happen? I mean, obviously in Wynwood we can kind of trace it back to a handful of people that ultimately kind of got artists to sort of buy into this sort of idea. But I mean, what are the challenges there of getting people to sort of buy into the idea?
You kick the old people out.
Gotta keep the old people out. Okay,
well,
fair enough. All right.
Showing the numbers, what the numbers can do, the benefits that will come out of the numbers.
Okay, possibly.
What's the value add?
Okay, what is the value add for something like Wynwood? I mean, let's go back, obviously 10, 15, years, but I mean, what's the value add there?
The rehab of the community. Right?
Okay.
It used to be very dangerous.
Okay, so you've got to do what? You've got to change perceptions.
Change perception, yeah.
You've got to change perception on basically, okay, maybe it's not as dangerous as people thought it was. You've got to, and how do you do that? Well, is it through just extra lighting? Is it through an increased, police presence? Is it,
It's a combination of
yeah,
everything.
okay.
Plus the location, right? It's near pretty much everything.
Yeah,
Miami
so I mean,
Beach, downtown.
that was a golden, sort of nugget right there, the fact that it's the close proximity to, so many other things that are of value, but yet still, for whatever reason, it never just sort of, poof, took off before. And, what do you think were some of the inhibiting factors, other than the perception of crime and the derelict nature of the buildings and,
I think it was regulation.
okay, regulation?
I think it was regulation. The commissioner plus the, oh my God, the mayor during the time were not really,
Receptive to being,
Receptive to it.
being able to kind of work with folks to maybe relax some of the building code standards and allow the owners to be a little bit more creative with what they were doing.
and corruption.
Yeah, well, and corruption too, okay,
Well, it's Miami.
sure. Fair enough. But I mean, I guess my point with this, I do think this is an absolutely, mission critical kind of thing that, because I mean, I'm sure we've all seen projects that you would think would be successful, but then were absolute, utter mitigated failures for one reason or another because of, some of these elements that they weren't able to, convince folks that it was a great idea to come there and actually shop there or live there or work there or whatever it is, and, can really, never really get that project up off the ground. Okay? So, this next one, sort of the low long-term capital cost, relative to competitors. What are we talking about here in terms of capital cost?
The cost of debt.
Okay, cost of debt and cost of equity, okay, and the cost to basically raise money, all right? So this is one of the things that I probably spend a lot more time, obviously, on in the finance course, because that's really, it's all about where do you get the financing and ultimately how much does that financing cost you and so forth. But here, this whole thing of if you've got a massive portfolio of properties, it's going to make a lot of sense for you to spend some time shopping around to be able to get the absolute lowest cost debt that you can get on that set of properties. Okay, and at the same time, for your investors, hopefully being able to give them a yield that, is sufficient to get their interest in the project. But there's also, something else that is a little bit of a trade-off. Think about this. As you increase your debt level, in other words, as you increase your leverage, what does that do to the overall project risk?
It becomes a greater risk because there's now less money to actually go into the project because you're servicing greater debt.
Okay, that's one way to look at it, and that's accurate. But also, that extra risk is that your investors potentially could lose their money much quicker in the event of any sort of a decline in the market. That if you're highly leveraged, you've got a lot of debt, then if all of a sudden market rents were to dip a little bit, or vacancy rates, were to increase, then, how susceptible does that make that project? And so, that's something to, consider as well is that, many projects now are taking on less and less debt. And part of the reason is because the owners are scared that in an economic downturn that they don't want to be left in a situation of where they're going to be extremely vulnerable to being foreclosed on, okay? Because they've seen, I'm not saying it doesn't exist that you have high leverage now. What I'm saying is, at least in my lifetime, I've seen 2 or 3 times of where you've had people be over leveraged and then ultimately the market shifts in a significant way, and then all of a sudden those people with that high level of debt, that high level of leverage, get totally screwed in the sense that now they're not able to pay the debt service on the property, and ultimately the property gets foreclosed on, and you have a disastrous effect ensuing from that. So that's kind of an interesting thing in and of itself. But here the big issue is just simply what are those sort of the cost of debt, what is the cost of equity, and how competitive can you be relative to whoever else is in the same market that maybe you are, and if you can have that competitive edge relative to them, having that lower cost of debt, how much does that allow you to maybe have lower rents or offer better services to your tenants? Okay, does that make sense?
Well, aren't projects like less leverage than they used to be?
That's what I'm saying.
Yeah.
Yeah, so now, for the most part, they are less leveraged, but, historically, it was all about the leverage.
Well,
And that
and,
was,
and the book talked about what, 90 to 110%, loan to value and stuff like that. So
yeah, almost in every single real estate crash we've had, so much of the reason for the crash occurring was because people were up to their eyeballs in over, borrowing on property. And because it doesn't take that much in a decline of rent. If all of a sudden you have been charging, I don't know, let's just say $15 a square foot, and now all of a sudden all the market will bear is maybe $10 a square foot. Well, that's going to have a devastating impact to the point of you're probably not going to meet your debt service. Okay, and as a result of that, how many of those owners have a lot of extra cash sitting around in their back pocket to be able to pump into the project? Most of them don't. And so you have that sort of huge sort of almost domino effect of properties being foreclosed on. Okay, so this next one they talk a little bit about low overhead relative to competitors. Once again, pretty straightforward. This is just simply that in terms of the types of back office operations that you have relative to your competitors, if you can do a good job of sort of maintaining those and being, very efficient, with those sort of costs, then hopefully once again, it gives you another competitive edge relative to everybody else. Then enhanced revenue opportunities relative. Now this one is kind of an interesting one because here they're not necessarily just talking about the rental revenues associated with the property. Here it's like, what are all the ancillary services that you might be able to charge that are maybe not necessarily core real estate services that potentially could add value, to the property? At a very micro level, this is the sort of thing we had talked about a little bit before of, parking fees, dealing or having billboards and signage, cell towers on your property. Having concierge services for apartment communities. There's a lot of different things there that potentially could ultimately generate that much more revenue for sort of a captive audience, but once again could make your project that much more valuable, that much more sustainable in terms of what it sort of brings to the table. Okay, risk management. What are we talking about here? Okay, to a certain extent, yeah, kind of an insurance, but also what kinds of things, I guess, would we sort of put under the rubric of risk management?
Proper assessment of the property, proper assessment of financial conditions.
Are there things maybe that are potentially dangerous that we need to be, aware of, on the property that need to be repaired or replaced or, maintained? Are there, issues obviously in South Florida with respect to weather conditions that could potentially impact the property? How protected is the property? Or do we have backup systems in place of generators or whatever else it might be to be able to deal with those kind of unexpected circumstances? So any and all of those sorts of things. Because once again, if you think about it, that if your properties are better protected, better maintained, and at a higher degree of operating efficiency than your competitors, to what extent does that make you that much more valuable, that much more sort of sought after, even as an owner of property? Okay, now from a property management perspective. And then operating efficiency. This one, I didn't see a whole lot of difference here between that and the sort of overhead thing, but ultimately this sort of comes down to, to what extent are you being really cognizant of the cost that obviously you're incurring, and really trying to get the property up to sort of what I've always referred to as kind of maximum operating efficiency of, you're getting it as, getting the highest rents you can possibly get, getting the lowest vacancy that you can possibly achieve, getting the lowest level of operating expenses, the lowest cost of debt, and once you've achieved all of that, you're sort of operating at peak performance, and there's not much more you can do after that, and at that point, this, for the most part, is just going to be an asset that you're going to hold and hopefully try to, get whatever revenues you can off of your, off the property during that holding period. But, okay, all right, thoughts, questions, observations on this before we kind of move on into the computational aspect of this? Okay, so, let's take a look.
Actually,
Yep.
going back to your initial assessment of risk, has risk ever taken place under the assumption where they've reached max rent or peak rent prices? Has that ever toppled somebody?
Yeah, all the time. Because think about it. Every owner or new owner likes to think they are somehow going to be better than the previous owner with respect to getting higher rents and achieving greater efficiencies, and well, if they're smart, okay, they're always going to be thinking that. Now the question is whether they can actually achieve that, because seriously, how many prospective investors are going to go into a deal and going to say, we're going to lower rents, we're going to raise operating expenses, and seriously, you're not going to do that. Almost in every single instance, it's like you're trying to think of it in the most positive terms imaginable, and that's what gets a lot of the folks in trouble, because they're acquiring these things and thinking that they are still value plays, when in reality they're not. They're sort of operating at their peak performance, and there's not much chance of upside, and if anything, it's just the opposite, that they have reached kind of a peak level of rental income, and potentially as a result of that, if the market is truly being responsive, what has the market done? The market has created new product to go into competition with that product, because the market says that's too high of a rent level. Let's build some more product to compete with that at maybe a lower price point. Does that make sense?
No, it does. It does. Because everybody goes into it. Well, I'm gonna just buy it and I'm gonna just raise the rents and make my profit that way.
Yeah, because I think everybody thinks they can do a better job than the previous person or entity, whatever that is. And in some cases they can, because maybe they have some sort of special sauce that they're able to kind of add to the mix, that they have maybe the economies of scale or the experience or the connections or whatever else it might be to be able to achieve that. But that doesn't always exist. There may only be so far you can really push it. At least that would be my opinion. Okay, all right, so let's take a look. So let's say we've got a situation with a firm that, okay, first of all, tell me how many billions of dollars they have under their management. Give me a number.
2.3.
All right, $2.3 billion of assets. All right.
I'm gonna write that all the way up.
All right, and in this case, let's say that they've got what percent debt?
30%.
How much? Really?
Okay, 60.
Okay. I know we said low leverage, but that was a little bit low. All right, 60% debt, which would obviously be 40% equity. All right, and so what's our cost of debt, percent-wise?
6%.
7%.
This would be
Overshooting.
average.
Okay, maybe something a little bit lower.
6.
6? Hush.
6% interest cost. All right, and what about the return on equity?
Say 15.
All right, now let's say that firm, we want to compare it to another one that's of equal size, also 2.3 billion. But yet it's got, I mean, a little bit of a different capital structure. Let's say that it's got a little bit less in debt, maybe 55% debt, meaning 45% equity. And let's say that its cost of debt is 5%. And over here, maybe the return on equity is 20%. Okay? So what I want you to do, using just that information alone, what are basically our cost of capital associated with each of these two different entities? They've got the same dollar value of assets under their management, and then on an annual basis, their cost of debt is 6%, and they've got to give their investors 15% up here, and then down here, a 5% interest cost and a 20% return on equity. So I want you to sort of figure out what is our cost of capital, and then also what that represents in terms of a dollar amount in terms of their cost of capital.
On an annual?
On an annual basis. So, play around with it. And you can work with your neighbor if you need to.
It's not weighted average capital count.
It is, but we're also just going to be looking at the dollar amount as well.
Yeah.
So it's not just the percent, it's going to be the dollar amount.
Weighted average capital count. That's what I was looking today. Weighted average cost of capital formula. Cost of the equity times the percent of the equity. Plus the total of that times the percent of that.
The initial calculator will take that many, you know, if you want to type it in all the way across. In terms of $2.3 billion.
There's no tax rate.
That's it.
It's 60%, that is 0.06. And this one here is 1.3 times the 5%.
It's supposed to be 1.4. But it's giving us the return on equity.
Okay. Yeah, right, right.
Okay, everybody match up?
How did you get the last, what did you do to get the very last number?
Just add the two together.
The interest in the,
Yep.
and the ROE.
Okay, so let's take a look. Pretty simple calculations. All right, so we've got $2.3 billion of assets. And what we're saying is that 60% of that is comprised of debt that we've got to pay 6% interest cost on. So we just simply take 2.3 billion times 0.6 gives us basically the 1,380,000 or 380 million, okay? And we multiply that by 6% for our cost of debt. So our annual interest cost for that portfolio is 82,800,000. Does that make sense? Yes or no?
Yeah.
Okay. Now we do just to kind of keep in the same sort of thought process, we do the same thing down here, except this one has 55% debt, so a lower debt load and a lower cost of debt. So we do the math and we end up with 63,250,000 as the cost of debt for this portfolio, okay? Does that make sense? Okay. Now that we go over on this side, and we say on the equity side, for this portfolio, it's 40% equity, and then that represents $920 million. Our return that we have to give each year to our investors is 15%, so that represents $138 million that we've got to give to those investors each year. So if we take the 138 million and the 82.8 million, add those two together, then that means to satisfy our debt, satisfy our investors, we've got to have $220 million basically in terms of our, excuse me, our cost of capital to, in essence, give to both our lender as well as our investors. Does that make sense? On a before tax basis. Okay, does that make sense? Yes or no?
Yes.
Okay. Down here on the same portfolio, by doing basically the same thing, just the math is obviously, the same, but ultimately the result is different. So we're seeing this portfolio has a higher cost of
Debt load.
okay, well, it has a higher cost of capital, but the cost of debt is actually less, okay, in terms of the percentage cost of the debt and the actual cost, because we're borrowing a little bit less money. What's driving this in this particular instance is that we have a higher cost of equity that we've got to basically take care of relative to these guys, and a higher percentage of equity that we've got to pay off. And so as a result, that's what's really driving our increased cost of capital. Now, sort of comparing these two, and just subtracting those total numbers from each other, let's do that real quick, basically taking these two and getting the difference. Okay, so a difference of 49,450,000 per year. Okay? So, in the context of basically this whole thing of lower capital costs relative to your competitors, in this case, we didn't do as good of a job of sourcing debt as potentially these guys did, correct? But apparently, whoever our investors are simply don't demand as high of a rate of return, okay? So, under those conditions, we're able to achieve a lower overall sort of operating cost with respect to our cost of capital. $49 million a year, that's something substantial, okay? That's one of the reasons why in this particular, we're dealing with, let's say, these massive portfolios of real estate product. We're not dealing with obviously the mom and pop kind of, differences of operation, but here, that 1% difference or certainly 5% difference in the cost of equity does make a dramatic difference in terms of that we don't really, here's I guess a simple way of thinking about this. This portfolio is able to operate, at a much lower cost of capital, meaning it's going to, actually have probably more money left over that at the end of the day, above and beyond whatever that required rate of return is to give their investors than these guys are. Okay, does that make sense?
I saw an article on Friday. It said that Brookfield Management, the CEO came out and said, we underwrite every deal as if we're about to hit a recession or something like that. I thought it was
that's precisely what we're sort of talking about, is that, and what that basically means is we have low leverage. We're not borrowing as much as maybe other folks are. Therefore, in the event that prices plummet, values plummet, rents plummet, all those sorts of things happen, they're still going to be able to own their property and operate their property because they don't have to worry so much about that level of debt that they've taken on. Now, what will suffer is that maybe they're not able to give their investors as high of a rate of return as maybe they ordinarily would, but their investors are probably going to be pretty happy they're going to keep their property as opposed to losing it. Okay, does that make sense?
Yeah.
Okay. Other questions or thoughts about this?
So what does the 220, 800 mean?
This is our cost of capital, annual cost of capital. And this 49 million would represent either the cost difference or savings relative to your competitor.
That's their alpha.
I'm sorry, yeah. Or delta, really, difference.
No, I get that.
Okay? Questions? Okay. Moving forward. All right. So let's say that we've got operating cost of how many millions of dollars on an annual basis for this particular firm that we're going to take a look at? 3 million? Okay. All right. So we've got $3 million of operating expenses, and what about an equity valuation multiple? We talked a little about this last week. So instead of a cap rate, we're sort of looking at kind of the inverse of that. What is an equity valuation multiple? What are you doing?
Spread over time, or like years, it could be, or months.
Not necessarily. It's a different way. It's basically saying that whatever income that you may have, or whatever savings that you may have, or whatever operating expenses maybe that you no longer have, or whatever it is, that you can then take that number and multiply it by this multiple, and that will basically translate into the value for the property. Okay? Another way to sort of look at it, it's kind of,
Hold on, so that's your operational efficiency?
yeah, hold on. All right. Our normal model, as it relates to income, is ERV. Where we've got net operating income up here, we've got a cap rate or rate of return here, and then we've got value there, right? Okay? But you could also have kind of the inverse of that, which I would call VIF. So instead of ERV, it's VIF. All right? And in this case, the value is up here, okay? And then you have the income down here. And then here you have a factor, or what we're going to call a multiplier. All right, so in this case, let's just kind of put just some simple numbers in here to kind of illustrate the concept. So let's just say that we have $100 a year of NOI, and we have a cap rate of, let's say, 10%. That means our value would be $1,000, right? Okay. This is kind of supplant that over here. Let's say we have a value of $1,000, basically just kind of transporting that over here, and we have an income of $100. What does that mean our factor is going to be? Well, 1,000 divided by 100 means a factor of 10. Okay, not 10%, but a factor of 10. Simply saying that whatever we multiply the income by, that's going to give us our value. Now in here, this is a little bit confusing because I purposely use 10% because you're saying, well, this is 10% and this is 10. Is that not the same thing? Okay, let's just change them a little bit just to kind of illustrate the concept. All right, let's just say we make this a cap rate of 5%. Okay, what does that mean that our value is going to be?
2,000.
2,000. Okay, so if our value is 2,000 and our income is 10, or I'm sorry, 100, then that means our factor is going to be 20. Okay, so basically whatever income that we have, you multiply it by 20, that would be the value. Okay, so it's not that one is better or worse than the other. It's simply a situation of that a lot of finance people, traditional finance people, tend to think of things in terms of like earnings multiples. You hear like earnings per share or earnings or price earnings ratio and things like that. In many instances, it's using some sort of a multiple or a factor, whereas real estate folks, for the most part, tend to look at everything as sort of a rate of return or a cap rate, more of the percentage. Okay, well, in this particular part of the text, and also kind of when you're sort of blurring the lines between what I would call traditional real estate and more of sort of corporate real estate and institutional real estate, you tend to have players that tend to refer to everything as sort of factors and multipliers as opposed to cap rates. Okay, that's the simplest explanation I can kind of give to kind of help to, you know, explain it. So in this particular setup, what we're saying is, okay, we've got this $3 million of operating expenses, and we're going to pick, let's say that we've got an equity valuation multiple, let's use 20, what the heck, all right, of 20, then we've got, let's say that we can reduce, our OPEX by, let's say, 10%. Okay, what does that mean in terms of a creation of value? Okay, using just those numbers, how much value can we, in essence, create from that?
Your value is now at 63 million, because you're now adding.
Okay, so if we take, basically, in this case, 3 million of the OPEX, and we multiply that by 20, what do we get?
60.
Okay,
And
and we can, in essence, reduce that by 10%, so in essence, take it,
You're at 54 now.
right? Well, no, it's in, well, hold on. Here real quick. All right, we got the 100 million. I'm sorry. Okay. Times 25 equals 25. All right, so 3 million times 20, we go 60 million. And then if we can reduce it by 10%,
6 million. So you're now adding
all
54
right?
million.
So in this case, this will create $6 million in equity value. Okay?
6 million additional dollars.
Right, in equity value. Because what we've done is we have in essence, by saying, all right, if we're able to reduce our operating expenses by 10%, and that's obviously 3 million was the number of the operating expenses, we multiply that by 20, get 60 million, but we take 10% of that, 6 million. What that ultimately is going to translate into is $6 million in value creation, basically. So if we kind of go back over here, just to sort of draw the comparison. $6 million in extra, and we got a 20. Or 300,000 would be the change in income. Well, where's that 300,000 coming from? $3 million in operating expenses, 10% reduction would be 300,000. Does that make sense?
Can you just summarize that again?
Okay.
Yeah, from the very beginning.
From the top.
Okay. So the property has $3 million in current operating expenses.
Okay.
Okay. And what the shorthand way to sort of look at this is we know that we're going to be able to reduce those operating expenses by 10%. Okay? So before we go through the other pieces of the calculation, if we want to, we can just simply say, okay, $3 million in operating expenses, we're going to reduce it by 10%. That represents $300,000 basically in income savings that we have generated. Okay? Then we can simply, if we want to, then just simply take that and multiply that by the equity valuation multiple, okay, which would then give us, in this case, what is going to be the actual change in value, okay? But what you're doing over here is you're basically saying, okay, kind of for the overall project that's 60 million, ultimately you're working it just a little bit of a different way mathematically, but you're coming up with the same result. The result that you're trying to achieve, just to keep it simple, is what is, in this case, the change in the value for your equity, which is the 6 million. It's not saying that your total value is 6 million, it's saying that the change in the value is 6 million.
Is this change going to change your market value?
That's exactly what it is. This is the change in your market valuation. Okay? Because all we're saying is you're in essence able to have $300,000 in cost savings off of your operating expenses. Okay? Let me just oversimplify it. You have a property, you're able to lower your operating expenses. Lowering your operating expenses does what? It increases your NOI, yes?
Yep.
Okay, so in essence, it's increasing your NOI, increasing it by 300,000. Does that make sense? Because you're reducing your operating expenses, so it increases your income by 300,000 using this factor or multiplier of 20, which is given to you. 300,000 times 20 would then mean the property is now worth $6 million more because of those cost savings. It's just, this is no different than what we did when we were playing around with it using IRV, okay, or the cap rate model. Here we're just using a factor to basically do the same exact thing, okay? It's just that slightly different sort of terminology, but in essence, all you're really trying to do is to show what can you do to the valuation of the property by lowering operating expenses. Okay, does that make sense?
How would you know if you were buying a shopping complex or a whatever in Maryland and you didn't know, you know, your valuation multiple? How would you be able to use it? Is it a
So
common?
what you could do in some cases is use some of the national sort of reporting data from like the Building Owners and Managers Association or Institute of Real Estate Management or some of the others that produce sort of nationwide statistics about operations of apartment buildings, office buildings, shopping centers, and will give you, in essence, percentage breakdowns of income relative to expenses by property type, by geographic location, to be able to make those sort of comparisons.
Okay.
Yep.
Professor, so if you had the opportunity to achieve that 10% reduction operating, what would be the smartest thing to do with that $6 million? Reinvest it in the property?
Well, it's not real money until you sell it.
Until you sell it, yeah. Okay.
That's the thing. I mean, yes, you're saving, you know, $300,000 a year. So you could say, what am I going to do with that $300,000 a year? You know, in terms of reinvesting it into the property, or you know, in some way or another, or pocketing the extra cash as you know for the investors. But at the end of the day, all you're saying is that translates into a change in the overall valuation of the property by $6 million. This all gets back to the overriding theme, which is how do you make the property that much more efficient? And here, reducing operating expenses, and what is the impact of that on the value?
The $6 million represents the overall savings. Does the 300,000?
No, this represents the annual savings.
Oh, that's the annual.
This represents the change in the value, the increase in the value of the property. The property is not worth $6 million, it's worth $60 million. Okay?
So a $300,000 savings
50
raises it up to $6 million.
It increases, the incremental.
Well, now it's 66 million.
Right, yeah. Okay. In other words, it's a whole thing of like, for example, kind of using the IRV model here a little bit, we're basically saying, okay, we've got $300,000 of additional income. That translates into a $6 million increase in value. What's the cap rate or rate of return on that? %5. So in kind of real estate vernacular, we're just sort of saying, for every dollar of income that we're generating, that ultimately gives us a 5% rate of return on whatever it is that we're investing, in this case, the $6 million, another way of flipping it around. Okay?
So the 300,000 there represents the decrease in operating expenses.
Or an increase in net operating
In operating
income.
income. Okay.
Because it's in essence the same thing. Okay? All right, moving forward. Now, okay. All right, so let's do another one, sort of lower overhead cost. So we've got cost savings of $15 million annually. All right, and given that we've got a, let's say, a 20 times multiple, what is the creation of equity value? So this is even simpler. What are you going to do? You're solving for the creation of equity value.
Multiply 15 million times 20.
So once again, it's going to be kind of our VIF model. All right. So in this case, we've got the cost savings, which in essence is our income of 15 million. We've got our multiple or our factor of 20. What does that mean that our value is going to be?
So you have to multiply 15 million times.
So 15 million times 20.
Are we reducing our operating expense by?
Nope, this is just simply, we're just saying cost savings. So we're trying to simplify it a little bit. So that means that's going to contribute 300 million to the overall value. Okay? Make sense?
Is this just a rough way of, up north when people buying buildings, they look at what's the income and then they say they're gonna multiply it by so much. And every different person you talk to multiply by
Yeah,
different
it's
number.
just another way of looking at the cap rate. So once again, we can do the same thing using the cap rate instead of, so here we'd have 300 million. The income would be 15 million. All right, so 15 million divided by 300 million. Once again, 5%. Just happened to be that. So it's no different. The factor or the multiplier is 20, but the rate of return, if you look at it, using sort of a cap rate perspective, it's 5%. It's all, and as I said, the only reason that we're really doing this is just because there's been this blurring of how, as I said, pure finance types tend to look at things versus how pure real estate finance or folks look at things. The real estate folks tend to look at cap rates. The pure finance institutional folks tend to look at factors and multipliers. That's all there really is to it. Same general thing. Okay? But to answer your question, the whole thing boils down to a new owner would come in and say, or an existing owner would say, what can we do to basically achieve cost savings? How is that then going to be multiplied out in terms of a creation of additional value for the portfolio? Okay? Because think about, okay, if you were, ignore real estate here for a second. If you take over a business, probably what is one of the first things you're going to look to do? Reduce costs. Why? Because in essence, it increases your operating, flexibility, but also hopefully will create some additional value for you. Okay, and so in virtually every single instance, that's the very first thing you do. Now, why? I'm trying to think of a good way to sort of ask this question, but why is it sometimes it takes new ownership in order to make those things happen?
Operational efficiencies.
Well, different set of eyes, see, where things could.
Okay, maybe someone new takes a fresh look at the operations and really does question, why have you been doing it this way? Clearly that's inefficient, clearly that's wrong, clearly you could improve on that, but yet you have maybe existing people in the organization that said, well, that's the way we've always done it, we're comfortable with that, our processes are set up to support that, and the new owner is basically saying, what? Too bad, so sad, we're changing because we think we have a better way of doing this that's going to yield, hopefully, higher revenues and lower costs associated with those revenues. I mean, it's not rocket science, but at the same time, it sometimes takes that fresh set of eyes to be able to, get past. And also, it's not just a fresh set of eyes, it's also, they don't maybe have the organizational baggage. Think about it like this. Okay, assume that we had a company and you're the current owner, CEO of the company, and all of these are your current employees, all right? And you know that there's a handful of these current employees that maybe haven't been doing what they need to do to maximize the value of the company, but yet they're your employees, maybe they're your friends, they're, you know, people that you've been around forever. And so you're just sort of saying, I really can't make the changes, or really don't feel comfortable making the changes that I need to make. So I'm going to sell it to this outside guy who doesn't have any of these relationships at all and can come in and do what? Completely rethink, retool, and, you know, hopefully make, you know, now, but in the process, it's probably going to either fire or change or, you know, whatever to make the operations that much more efficient. Does that make sense? Okay.
Question.
Yep.
Doesn't the new owner, aren't they typically buying it at like a higher cap rate? So
And they could, and and sometimes the only way then they're able to get the kind of return that they need to get is to have those operational efficiencies as well. So it's kind of like, you know, they're going to have to deal with it one way or the other. Okay.
Does the cap rate tell how valuable a property is? If you're buying a property in Manhattan, New York, you'll be happy with 2%.
Mm-hmm.
But if you're buying it if you cross the bridge and you go to Brooklyn, you might say, I want 10%.
Sure. Cap rate varies by geographic region, based on competition. Because you have a lot of people, for whatever reasons, that want to be in Manhattan, that maybe don't want to be in Brooklyn. Or that they view Brooklyn as being more risk, or they, you know, there's just, out of necessity, they need to be in Manhattan. You know, there are a lot of different, you know, factors that come into play. And I have said, you know, many times that usually the best real estate plays are not in the major markets. You know, they're in the tertiary markets. They're in the outskirts, as long as those markets have strong economic basis. I mean, for many years, not as much today as it once was, but, you know, college towns all over the country, you know, had probably some of the best real estate markets for investors that existed. Because you had a strong economic base of a university with, you know, the salaries that were being paid, but the thing that people overlooked was the value that was being brought in by the students that were maybe living in that town, and the amount of money that they were spending on goods and services.
Yeah.
Because that wasn't being reflected in census numbers, okay? Because, I mean, imagine if you've got a college town, and the one that, you know, obviously I'm most familiar with is like Texas A&M, you know, in Bryan College Station. You know, you've got now, I mean, back then it was like 40-something thousand students, but now it's, you know, greater than that. But you had 40,000 plus students that are coming in, none of which are from Bryan College Station. They're all from other parts of the state, other parts of the country, and they're all coming in with allowances, you know, from, you know, their parents of, you know, a few $1,000s a month in some cases or more, and, you know, buying goods and services. And so for many years, that was being completely ignored by the census because they weren't residents. They were students, and they weren't being counted as residents. And the purchasing power wasn't really being, you know, fully embraced and really thought of. And so for many years, they had very few goods and services. And then all of a sudden, you know, people were starting to look around and say, wow, what is it about these restaurants here in Bryan College Station that they're doing so well? What is it about these retail stores that they're doing so well, but there's so few of them? And then eventually the light went off, and people began, you know, national retailers began to realize, oh my God, there's a huge demand for this product here, so the kids don't have to drive 100 miles to go to Houston or 100 miles to go to Austin to buy the same product. And, you know, and it just sort of like an overnight explosion of just a realization of that kind of information. But my point is that, you know, sometimes there are those really hidden pockets of opportunity because the big players are ignoring them because they don't fit the mold of, quote unquote, the major market that is going to be, you know, looked at by everybody, you know, from an analytical point of view. Okay? All right, moving forward. So, all right, here's another. So let's say that we're able to achieve some economies of scale and we're going to increase your revenues. Are going to increase by what percent a year? Give me a percent.
5%.
Okay, 5% a year, and with no additional cost. Now, assume that your net operating income is currently, let's say, 50 million per year. All right, and the cap rate is 9%. All right, so in this particular case, what dollar amount will this increase in revenue have on the value of this property?
What's the question?
Okay. What increase in value will a 5% increase in revenues have on a property with a $50 million net operating income and a cap rate of 9%? Okay, who has the answer?
I think I have the answer.
Okay, what do you have?
583,333,333.33 cents.
Okay, let's see. All right, so first of all, let's just put our little IRV down here on paper. All right, so our income is 50 million. Our cap rate, 9%. All right, so our current value,
1,050 million.
okay, let's just see.
Oh, it's 9%.
555
That was
million.
5%. Oh, the revenue is 55%.
You want the difference or the overall
Well,
sum?
I'm just, hold please.
9%.
Okay, so that is the valuation. Now, in this case, it's going to go up by 5%. So the cap rate's going to stay the same at 9%, but the income is going to go from 50 million to 52 million 500,000. So in other words, times 1.05 is going to give us this. Okay, does that make sense? All right, so we do that, divided by 9%. Okay, so our value would go up to 583 million versus the 555 million. Now, what I may ask is, well, what's just the difference between those? Okay, so just subtract one from the other.
2778.
Okay. So the difference will be $27,777,777 and some change. Okay, will be the difference. Or the increase in value. Does that make sense? Yes or no? Now, you could have shortcut that process by doing what? If I was just asking for the difference, you could have just simply said, okay, what is the difference between the income? The difference between the income is what? 2.5 million. So you could have just said 2.5 million divided by 9%. We get the same answer. Make sense?
Hold on.
Because 2.5 million is just simply taking the 50 million, multiplying it by 5%, which would give you the 2.5 million. Okay? All right, we're getting there. Okay, we'll do this one, we'll take a little break, and then we'll come back for the second part.
Okay, I'm sorry, could you just go back for 2 seconds? Alright, thanks.
All right.
This last example, you didn't give us a multiplier.
Yeah, in this case, I just give you a cap rate.
So
Okay.
we're not able to use the other scenario multiplier that we have.
In this case, no. So I didn't give it to you. All right. So leverage. All right. So let's say that we've got a property with net operating income, annual net operating income. Give me a dollar amount. Millions of dollars. How many?
16.
16 million. You are the most random number generator I know. Okay, 16 million is going to be your NOI, all right? And let's just say that you've got a cost of debt, oops, of 6%, all right? But more specifically, we've got a debt service coverage ratio of 1.15, all right? And over time, the lender begins to tighten up that requirement from a 1.15 debt service coverage ratio to what? In other words, you're going to increase it.
1.2, 1.25.
Sure, 1.25. Okay.
It's a toleration, went up.
Okay, if you remember, once again, debt service coverage ratio is equal to what? Net operating income divided by annual debt
That
service.
is the ability to service it, yeah.
Okay, so in this case, if we know that we've got 16 million in net operating income, and we have to apply a 1.15 debt service coverage ratio, what does that mean that our annual debt service is going to be?
Your loan payments.
You're simply going to take 16 million and do what?
Or your loan.
Times 6%.
Divide by 1.15, and that's going to give you 13,913,043. Okay? All right? If your debt service coverage ratio were increased to 1.25, you take the 16 million divided by 1.25, and that would give you 12,800,000 as your maximum annual debt service. Okay, now why is that important to us? Why is this annual debt service number important to us?
That's what we're gonna pay out to service.
Okay, that's what we have to pay out to service our debt, but it also, another way to look at it is that if a limitation is being placed on us by our lender in terms of this debt service coverage ratio, which in essence is impacting our leverage to a certain extent on the property or how much we can really borrow, then what is that really saying here? Okay, first of all, what's the difference between these two? Let's start with that.
Over time is going to increase the cost.
So the difference between these two scenarios is going to be 1,113,043. So what does that number represent? that means we're going to have less money that we're going to be able to put toward debt service. In other words, our lender is limiting us, okay? What impact is that going to have on us? That means that we're not going to be able to probably borrow as much as a result, okay? If everything else is held constant in terms of the loan term, the loan interest rate, you know, the loan to value ratio, if everything else is held constant, that reduces our basically ability in terms of our borrowing capacity, all right? And how much of an impact do you think that might have? Well, okay, let's just take a look. Okay, if that's the difference, I didn't quite go to this extent on the quiz, but I'm just going to sort of show you. All right, so let's just say we have one payment per year, and we were to put in $1,113,043 as our payment amount. That's an annual payment amount, all right? And we had an interest cost of, we said here, it was like 6%. And this just, I didn't tell you this, but let's just say it's a 15-year term. What would that mean would be the difference in the borrowing capacity?
10,800,010, 155.
So we would have reduced, or the lender would have reduced our borrowing capacity by almost $11 million, just by changing that one requirement with respect to our debt service coverage ratio. Does that make sense?
What's that, can you repeat that? Does it mean over percents?
This would just simply represent what our reduction in the amount that we would be able to borrow from that lender as a result of the change in the debt service coverage ratio. Okay? Now, of course, all I may ask is just simply, well, what is basically the reduction in the annual debt service that the lender basically is placing upon us by virtue of increasing this debt service coverage ratio? Okay? Does that make sense? Okay. All right, so let's do this.
Hold on, it's a decrease in the debt service.
It's a decrease in the debt service, which translates into a decrease in our borrowing capacity.
Isn't there a trade-off when you lower the ADS or the DCR?
What do you mean?
Where if they give you a lower debt coverage ratio, they usually give you a higher interest rate.
They may.
You know, so isn't there like a trade-off?
There can be, absolutely.
Where your borrowing power may increase, but then you have a higher, payment. You have
In
to
some
pay.
cases, yes. But in this case, we're saying everything else is going to remain constant. Just to see what the impact of just that one singular change would be. Okay? All right. All right, so let's do this. Take about a 10-minute break. There's food upstairs again. So if you're hungry, grab some food, come back, and then we'll tackle the second half of this. Well, going in is at the beginning of the project. Going out is at the end when you sell.
But is it strictly related to development, or is it also like a purchase?
It can be purchased.
Okay.
Yeah.
Purchase, 5-10 years, and then that's your
Yep.
She doesn't seem happy.
Well, it is, but we're not using that there. I mean, this is really extra information.
Oh, this was just extra.
Yeah.
So I didn't see that.
Right.
So you have.
Only used it whenever I went through and gave you some additional explanation.
So this is one or the other.
Not necessarily one or the other,
Or
it's
they
just,
should match up.
no,
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 they shouldn't.
not necessarily. Well, I mean, they are gonna match up in the sense that, yeah, that's gonna be the interest rate you're gonna apply, or that's gonna be part of calculating the annual debt service.
Part of.
Well, I mean, annual debt service is just your payment.
Right.
Your payment is gonna be derived from the dollar amount you borrow and the interest rate and the term. That's the interest rate.
For the, this is for the year though, right? When you-
No, well, just, this is your interest rate, the cost of debt.
So this is 960,000.
You know, whatever it might be.
So that's what's throwing me off. 'cause
Yeah, but that's irrelevant.
It's irrelevant.
Yeah.
Oh, all right.
Mm-hmm.
How would you do that?
Okay.
Like, for this,
Oh, you just divide it into the total.
so it would just be that divided by that?
Yep.
Let me see.
He basically does a whole bunch of deals. And he has done a lot of development in Latin America, so I wanted to do all of his stuff for whatever reason, but
That's interesting.
very long. That's been everywhere.
I see that cake down here, so.
Um, work for one of the largest recruitment firms in South Florida, number one, it's still in Dallas.
I was
So like
shocked.
$70 million quota.
I always thought that they would bring the companies here. There's a lot of companies that I used to work for, they used to have like the Latin American headquarters over here.
So while we're waiting on the other folks, go ahead and get your laptop and pull up the spreadsheet that I sent you the link for yesterday.
I downloaded it first this morning.
So that's what they can do like the plan. Sure.
I gotta take advantage of the situation.
Yeah.
Yep, click on that.
See, they improve it, man. We went all out today.
Is this the last one? Marcus?
I think I got one more left next week. But there won't be any next day.
Can we just roll that into our tuition? It just makes people so much happier when there's free food.
Is it all from the fundraising thing?
Yeah. Yeah, the cost of those breakfast, like per person cost, I think is like $15 a person. What our cost is in terms
For
of,
as far as how many people?
well, it's just based on a per person thing.
There's a lot of extra food though.
Yeah, I know, but it's like trying to get it where it's perfectly tuned with exactly how many people show up and how much they're gonna eat and everything else. It's,
Going over line by line.
I think it ends up being like $800 a week. Something like that. So it's just 800 divided by 15 bucks a person. So yeah, about 53 people, that's what they.
After a while.
Yeah, roll it right into our tuition.
Future value.
Oh, right. Yeah.
It's all the way at the end.
Present value 800.
Exactly.
Decided to because of the fund.
So, I'd like to grab things that I corrected.
And,
Okay.
Everybody's just going to town today.
I'm not.
the movie's slow.
I think they were late getting set up today, so maybe they didn't get set up in time before the class started, and so maybe that's the reason why. Is there that much more food than there normally is?
There was a lot.
Yeah, they
That's probably why. Yeah, because when we got here at about 6 o'clock this morning, they hadn't set up anything. Normally they have it set up like the night before. No, I got here about 4:30.
We just got that to stick around for about 4 hours.
Like 8-ish.
Oh
No, I'm very much of a morning person.
Yeah.
No, I'm sound asleep. I mean, literally by 5, 6 o'clock in the evening, I'm just,
So like 5, 6.
I was laying around like that. Stuff, or is it-
but no, they were always early risers. They both grew up on farms.
You have to go.
Yeah.
Yeah.
I beg you, listen to me.
Oh man, Florida is early. I'm here for like 3. I'm rolling over at 3.
Second.
Yeah, wait another minute and we'll get started.
Pretty good food.
Smells pretty good too.
Yes, that.
Everything will be spread.
So while we're waiting on the folks to get back with their food, so what do you think of the event last Saturday night?
Well, pretty good.
Very
Pretty good.
informative.
Very informative.
I sent my stuff to Emilio to send to a company that I'm interested in.
Okay, good.
Got 100 necklace, I didn't
Yeah, so we had a pretty good turnout. I think it ended up being, I counted about 35 people all told, so that's a good turnout.
Good turnout.
Yeah. Saturday night.
He's the guy he's talked first about like employees and
All right, once again, go ahead and pull up the spreadsheet that I sent you the link for yesterday, not the one I sent you this morning, but the one I sent you yesterday, which was the chapter 23 spreadsheet out of the book. Should look like this, the first or the second tab, 23.1. If you're having difficulty pulling it up, let me know. You're going to need it for the quiz. Okay, let's go ahead and get started. So, chapter 23 pretty much has one primary purpose, and that is to determine from a corporate perspective, should you do what or what?
Buy or rent.
Buy or rent, okay? And so what they've done is they put together a collection of spreadsheets to try to illustrate here is the way that you can sort of set up the analysis for that buy versus rent decision as sort of a corporate owner of real estate, okay? Or corporate tenant of real estate. So we're going to start with this first one and then kind of work our way through to the last one, and just in terms of kind of explaining a few things, and then we're going to have you do a little bit of spreadsheet work on your own that you're going to need for the quiz, okay? So this first one, what they're doing here is pretty much setting up the operating aspect of owning a building, okay? And so they give you all the characteristics, and the way that they have their spreadsheets set up, sort of the highlighted blue cells are the input cells, and then the black cells or the red cells are pretty much calculation cells that you don't really have to put anything in. They'll do all the calculations for you. So here, they sort of start off, you've got a $100 million building. The equity investment in that is $40 million, meaning the mortgage is going to be $60 million, okay? No big surprise there. We've got all that. That should ring very clear to everybody. All right, our interest rate is going to be 6% with respect to the mortgage. We're going to have an interest payment of $3.6 million. Now, how are you going to get that interest payment? You're going to take basically the mortgage amount times the 6%. That's going to give you the $3.6 million, okay? Pretty straightforward. All right, then we're being given operating expenses on this property of about 2% of the overall value of the property, or $2 million a year. All right, we've got an income tax rate of 21%. Then they also give you a couple of other pieces of information for depreciation so that we can go in, and in this particular case we're saying the non-land depreciation or the improvements value is 80%. And in this case, they chose to use 20 years as the depreciable life on average. And more than likely what they did was they itemized a lot of the individual components of the building to drive down that number for sort of accelerated depreciation. But nonetheless, they're using 20 years as the depreciable term. The depreciation tax rate, 21% for recapture depreciation, and then a 15% tax rate for capital gains. Okay, so those are their assumptions. All right, then the model they've got down below. Now the thing that they do, I don't know, everybody kind of has their preference on these sorts of things. What they've done is they basically have represented all of these values in millions of dollars, okay? And so pretty much whenever if you were constructing this on your own, which you're gonna have to construct a version of this a little bit later, so take note of this, is that you're in essence, whatever numbers that you populate down here, you're in essence having to divide them by $1 million, okay? So let's just take that first one as an example. So what you see here, in terms of the cell reference, double click it, all right? So what they're doing is they're basically saying, okay, that's $40 million, but they're taking the $40 million from up here, and then they're just simply dividing it by 1 million in order for it to show up as 40 down below. Okay, does everybody understand that? Okay. Personally, I've never been a huge fan of doing that because to me, I like seeing all the zeros. Okay, but that's just me. Okay. All right. Moving down. Okay, the interest expense. Okay. So what they have done is just simply, once again, they've gone up here and grabbed the 3.6 million, which is obviously from the 60 million times the 6%. Okay, so, and then taking that number and once again, dividing it by 1 million. Okay, everybody with me?
Yep.
Okay. You might want to pay attention because you're going to have to do this on your own in a minute. All right. Operating expenses. Okay, pretty much same thing. Go up here, grab the number, bring it down here, multiply it by, or I'm sorry, divide it by 1 million. All right? Oops. All right. Okay. In this case, we've got what is referred to as the interest tax shield. Okay? What is this? This is basically the benefit, if you will, of getting to deduct your interest from your income. Okay, does that make sense? Also, they just call it interest tax shield because it's basically shielding that income. All right? So in this case, what they're doing, as you can see, they've got, so D8, which is your actual interest payment, multiply that by the tax rate of 21%, and then divide that by basically the $1 million, okay? And so you end up with this, basically, what would that be? 0.756 in terms of actual dollars. 1,000. Okay? Once again, one of the reasons why I would prefer to have the zeros there, but that's just me because it makes it, you have to kind of translate that in a different way, but basically $756,000. Okay? Then right below that, okay, you get the depreciation tax shield. Click on that here for a second. Now this is a little bit more complex. I mean, once you really sort of think about it, it's not that bad, but you sort of take your initial building acquisition cost of the $100 million, and then you've got to multiply that by the non-land depreciation allocation. In other words, to get the improvements value, okay, which would be, what, $80 million. Then you're going to take all of that and you're going to divide it by the depreciable life of 20 years. So 80 million divided by 20 years. Then you're going to multiply that by the tax rate of 21%, the depreciation tax rate. Then you're going to take all of that, divide it by $1 million, and that's where you're going to end up with basically $840,000 as an interest tax shield. Okay? Does that make sense? Okay? All right, so once you've got all of that, then it's simply going to be adding all those up. So these are obviously negative numbers in red, positive numbers here, but adding them all up together, that means from an outflow perspective for owning the property, your outflow for this first year, because of your equity is going to be 44 million, and then each subsequent year of operation is basically going to be $4 million a year, okay, running across the page. And they did that for all 10 years. So this model only takes into consideration the operating cash flows of the business. Does not take into consideration selling the building, okay? That's in a subsequent spreadsheet, okay? Is everybody cool with that? Yes or no? Okay? Now, here, they did go ahead and just total up our total out-of-pocket cost just so that you could see the raw number of basically cash expenditures, or the net cash expenditures over that 10-year period of basically 80 million. Okay, make sense? Okay, now then click to the next spreadsheet, 23.2. Okay, let me blow this one up a little bit. Zoom to selection. Okay. So what this one is pretty much doing is accomplishing the same. Okay? So you got all the assumptions up here, pretty much the same as the assumptions before for the most part. And ultimately, all they're saying is, all right, at the end of a 10-year holding period, we're going to sell it for $130 million. You're going to have fees of $3 million, which are once again given to you here. You've got accumulated depreciation tax of $60 million that you're going to basically be able to subtract from the capital gain. You've got the debt repayment of $60 million, $10 million on the accumulated depreciation tax, $4.5 million on the capital gains, leaving you with net proceeds after everything is said and done of the $52,500,000. Okay? Does that make sense? Okay? Not actually asking you to do that calculation, just simply that's kind of the flow through of information. Now the number that's going to be of use is really this $52,500,000 because that's basically our reversion value after taxes. Yes?
The accumulated depreciation tax rate, it's wrong. I think it should be at 21%. Oh, I think it's 25.
And I'm not going to argue with you, but don't worry.
That's what the book
Yeah,
said.
but yeah, it probably should be. Because actually I think it's changed.
Oh.
Okay? So I think it was 25, and I think now it is either 21 or 26. Okay. Then we sort of move forward. Let's see this. All right. So here, we've got owning and selling the headquarters. So what they're doing here is basically combining those two previous spreadsheets with regard to the cash flows. So what you've got is basically kind of the bottom line, and then over here in year 10, you've got the reversion value after tax as to what that cash flow is going to be, and then you go over here and calculate the net present value of those cash flows. So if we click on that, okay, so the net present value is simply taking the interest rate up here that was given to you of 10% for the net present value calculation, and then saying, okay, take the values from basically year 1 all the way through year 10, which includes the reversion, and then give me the net present value for the ownership of that property. So what you're saying is that over the course of 10 years, the net present value of owning this property is $40 million out of pocket. Does that make sense? Everybody with me on that? Yes or no? Okay. Okay. All right. Now, in this one, if you read it in terms of the heading, faulty analysis of renting the property, because what happens sometimes, we try to oversimplify things, okay? And that's, it's just the nature of what we do, because sometimes including every possible conceivable variable, it's a question of, is it significant enough to make a difference? Some cases yes, some cases no. But in this case, what they're basically purporting is okay, with this sort of incomplete or faulty analysis, all we're doing is saying, okay, annual rent is $10 million a year, discount rate of 10%, put that in as a series of cash flows, calculate the net present value, and you end up with $61 as your cost of leasing, okay? What he's saying is that's really not complete, so pretty much ignore that. All right? Then you go over to figure 23.5, and here they try to make a partial correction by taking into account a lot of the other sort of factors in terms of what you need to kind of consider in terms of the different tax rates, the depreciation, and so forth, and what you're gaining, what you're sort of losing as a result of renting the property relative to owning it, okay? Then in this final spreadsheet,
Now, Professor, in that case, they're also assuming that they're going to sell the business,
yes,
right?
yes. So then in the final spreadsheet, whoops, that I have filled in, that you don't, because I did it and you haven't. One of the reasons I was here at 4:30 this morning, getting them filled out. Okay, so, all right. So here's what you're going to have to do. So on spreadsheet 23.6, you should just have a blank version of this, yes?
Yeah.
Okay, just one big blue blob. Okay, so what you need to do is you need to fill it in. But you're not just copying my numbers in the sense that these are all formulas, okay? And if you just, okay, let me make sure I'm very clear. So hear me when I say this. If you just copy my numbers, you're not going to be able to answer the quiz. Because what I'm going to do on the quiz is I'm going to say, change one of these assumptions up here, and then see what changes down here. Okay? So you've got to have populated it correctly. So here's what I want you to do. You can work in teams, but ultimately it's got to be you got to obviously put in your own information that you can use on your quiz, on your own computer. Those are the answers. You need to figure out how to get there, okay? In terms of using the information pretty much exclusively from the assumptions above, all right? So, I'll help you just a little bit, but to kind of get you started, so to remind you, for example, the 40 million. All we're doing to populate that one cell is to take cell C6, which is the cash investment in the operations, divided by 1 million, and that gives you the negative 40, but you're going to have to put obviously a negative sign out there in order to make it negative. Okay, does that make sense? All right, so I've given you one, see if you can do the rest.
Do you want us to keep the same formatting?
Try to, because you're going to need to make sure that you get the same answer. I'll help you out. I mean, I'm not trying to just throw you to the wolves on this, but I want to see how far you can kind of get. Once again, you can work with each other on this.
No, I'm fine with that. I'm with the same mentality as you, as the divide by a million.
Yeah, I mean, just to be, I wouldn't, let me put it this way. If you probably do change the formatting, there's a chance that you might screw something else up. Okay, so I'm going to give you a few minutes to kind of see if you can help work your way through this. And I'll give you a couple of little hints along the way. So here's what I'm going to do first. I'm just going to blow this one up so you can probably see the numbers a little bit easier.
Oh, yeah.
And also, believe it or not, all of this is in your book. So if you have your book, you can also use that as a frame of reference. This particular spreadsheet
Is on page
327.
Is there any reason, really quickly, why they're negative? Because it's going out, or?
Yeah, it's going out.
So all of them, we just need to, it needs to be a negative when we're entering, correct?
Yep, because it's cash outflow.
327.
Once again, feel free to work with each other. If you get stuck, let me know, and I'll point out what you need to do.
So you know how to select the numbers?
Okay, Edward, I just sent it to you,
Okay.
so you should have it in both your email accounts.
Yep.
Done.
First one.
Mm-hmm.
I'll figure it out. But that's the Should need to do an escalation.
Everybody figure out how to do the escalation?
The growth?
Yeah, the growth rate? Okay.
How would you do that?
Okay, so for the growth rate, and let's just start off with the initial rent payment. Okay, so the initial rent payment is going to be cell C3 divided by a million. Okay, but subsequent to that, starting in year 2, you're going to simply take the cell, obviously to the left, and multiply it by 1 plus the growth rate cell, but you've got to make it a static cell reference. That's the reason you can think $C, $4, so that it will copy straight across.
But does it start year 1?
Yeah, well, year 1 is going to be the 980, which is going to be simply cell C3.
Yeah, okay, so you're looking at excuse me. Growth rate.
I'm trying to find the non-land depreciation allocation for.
Okay, so what they did in this was they lumped it all.
But you have to fix this.
In order to get the depreciation.
Tax Shield.
I wasn't talking to you, young lady.
So what they did,
So they took the investment operations, they divided it by a million, and then divided it.
yep, they basically took the 100 million divided by 10 years times the tax rate.
It's the 1 year. You divide it by
C12 and 13. Average depreciable life.
You have to anchor, that's.
got it.
Depreciation
Oh
tax
my
shield.
God.
So it's a different formula than what they had in the example.
I just don't know the cell reference because
She's
I
asking me,
cannot
but
see
she's
it.
not.
I need the cell reference because I
Yeah,
can't
man.
see it go up.
You know what I'm saying? I got it. It's like my wife.
How do I,
What can you do?
how do you copy and paste here? I can't.
Depreciation tax shield is 12.
That's what I just.
How can you grab it?
I tried using the tax shield from the other one, but I guess I didn't want to top, right?
Take
Yeah, you don't need to reference any of the other spreadsheets.
Divided by
Just
nine.
use the information that's given to you on this
Divided
particular
by-
spreadsheet.
multiplication of depreciable life.
So if there's one that you need some help with, let me know, and I'll highlight it.
Should be 210.
I give up. Trying to do this in a cell phone is not gonna be easy.
Well, I'm sorry, I asked you to bring your laptop.
No, it's fine, I know. How many questions in the quiz is this gonna be?
6.
So how did you get the escalation again?
Okay, so for the escalation, all you're gonna do is, first of all, you're gonna just bring down the number from above, so C3, divide by a million, that'll be, and make that negative in year one, and then for year 2 and beyond, it's gonna be taking, referencing the cell next to it, in this case D23, and then multiplying that by 1 plus the growth rate, in this case cell C4, but you've gotta make that growth rate static by putting the $sign C, $4, that means it keeps it fixed in place. So whenever you copy over, it stays there in terms of a reference. And then you should just be able to copy straight over.
For the,
So like the next cell for like year 3, if you highlight it, you'll see, okay, it's cell E23 times 1 plus the growth rate. And then next one be F23, and so forth, so on.
Okay, so tax shield, I have.
on the regular interest tax shield,
Yep.
what is,
Oops.
So the interest payment and the income.
what is that
tax
multiplied
rate.
against? That's the,
Payment.
Tax rate.
the tax rate, the income tax rate?
So you're gonna take, in this case, the interest payment times the tax rate.
Interest payment,
So basically it's cell D24 times C9.
is it the,
In the
The-
investment and operations remaining, we just put 0.
is it the
Yeah,
depreciation
so-
tax rate? Yeah, got it.
Excuse me. Yeah, the investments in operations remaining, that's just gonna be 0 all the way across. And then you're gonna populate the year 10 with the 53,750,000 divided by a million, which is up here, given to you.
Oh, okay. And investment and operations is only on the first year, right?
Well, it's only the final year, the 10th year.
The investment and operations, only in the first year.
No, that's the total.
Where you see year 1, where it says 40, on the first.
Oh, yes, I'm sorry, yeah, yeah.
It's only on the
Okay, I'm
first
just
year.
looking down here, yeah. Yes.
Okay, all right.
Interest tax shield is the, no, it's the, it's 11, and depreciation tax rate is 21%.
What is depreciation tax rate equal?
The interest payment, the interest payment's gotta be the interest.
It-
It's just,
That's just whatever assumptions they
trying to
make.
make it equal, but it doesn't necessarily have to be.
A million. See.
Just drag it and it'll.
Oh, the depreciation tax shield. I'm at 2,100, I know. It's gotta be a 0 issue.
just be zero across. You just enter this in, you don't have to put an equation for it. And you get the 53 from when you sell it.
But you know, you said the discount rate?
Do you know why we're dividing?
Well, the discount rate is 10%.
Give you, instead of doing this.
Okay, so once you bet everything up above, then for the net present value,
Oh, that's right.
it's just going to be.
If you take all these and multiply by millions, it's like real.
Close, getting smaller.
This one's the sum of all this.
I'm just multiplying by the 10%.
I mean, it's gonna give no numbers.
Just equal.
No. Okay. Yeah, this constant.
I finagled it.
Usually discount.
Okay, so one person's got it completely done.
Value.
Okay.
Oh, this is all these values.
Was there's the winner for the day?
Does, okay, I'm gonna.
Even year 10, right?
Gotcha.
Put your thing on the depreciation tax shield.
Yep.
Honestly,
The cursor goes on
what's
1A.
his name's class, bro. A lot of, I don't remember a lot.
So it's-
That's what I created in my.
So C5 divided by a million divided by C12 times C13.
I got it a different way.
No, you can probably get at it a couple of different ways.
This was complicated because it's basically all the way that you buy it and then like you actually include
You have to like anchor the C5.
It's gonna take on average about 5 months to rehab it, full cosmetic. And then you know that if you buy it at one of those you can get 15% ROI, and if you change it to it'll actually tell you exactly what you need to buy it at to get 15%.
Okay, so let's take a look. Let's go up here.
And that's an easy model too.
Oh.
Yeah, it's so easy, bro. I know.
Is the 23?
But it's cool because I actually use it.
Yeah,
Like I actually, every day I open this up and I type in things.
Gotcha.
So
Yeah, it's a really
what
simple
you're doing,
model.
C5, 100 million,
I wouldn't have known how to do that.
divided by 1 million, divided by, so C12, which is the depreciable life of 10 years, times the tax rate for depreciation of 21%.
There's no reason that I pressed that. It's fake 2.2. And then now I just
No, me either, actually. I need to turn this.
Okay, anybody else need any assistance? Are we good?
Is there a reason why you did it different in this one than in the previous one?
I'm sorry?
Yeah, look at it. I don't have this one either. I'm like, nah,
It's gotta be the cash investment in operations times the rate.
Well, because what this one is doing, this up here is the rental analysis, whereas down below is just simply from the selling the property.
That was some good fun.
So once you have this done, let's just go ahead and let's kind of jump to the conclusion here for a second. All right, assuming you get the numbers that match up with me, then down here at the bottom, so this top analysis is basically what you're working on is the rental. The bottom one is selling it, okay, owning and selling the property. All right, so which one is better and why?
The rent.
Okay, the rent, because it has the lower negative number. Okay, so this is where, once again, you got to use kind of the reverse logic. You know, normally you search for the highest net present value, and this is the highest net present, but it's actually the best net present value because you're spending less money. Okay, so $28 or 28 million is less than 40 million. Okay, in owning it. So it's basically saying renting is better. Okay, is the conclusion from this. All right, now Okay, are you pretty much done?
Yeah.
Okay, give me a couple more minutes.
I'm done already.
That's clear.
21% rate. On the depreciation in Excel, the spreadsheet has a 25. So Professor, because of the change on the rate from 21 to 25, the Excel spreadsheet is different from the book rate. So I want to make sure.
No.
The tax on cash flow from normal operations. That's gotta be the cash flow from operations, which is the 12 million.
So pretty much.
And then multiply by some kind of rate.
OPT, OPT.
I'm not even on OPT right now.
But like eventually.
It's a certain
we
level.
don't-
Yeah,
But I want to.
You're gonna try to work into this, maybe? It's-
Okay, is there anything you're hung up on?
Yes, I'm trying to fill
That's
that
the
in.
position that I want.
And not
See, like, that would be your strength.
hold on.
This one?
This one.
It's just 12 million. It's on top.
So, investment is just zeros until you sell, right?
Correct.
For your undergrad?
Yeah.
Oh, my undergrad? No, my undergrad is and then I did my first one.
Tax on cash flow from normal operations, that's the 12 million.
Nah, accounting, I
Times.
understand, it's not like this. You're not looking at your profits, you're looking at like.
Credit
taxes.
side. That's where we're looking at.
Yeah, I don't even know that much about it, to be honest, but I know the basics is not what I would wanna do. You're just looking at the numbers of the operation, you know.
To be fair, you know, okay,
252.
you have pretty much like dominance over the entire financial assets.
Really.
252 negative.
If you know the logic of the accounting, it gives you,
Okay, okay.
you understand
okay,
everything
okay.
going on.
Investment
Not just
operations
credit
remain.
reserves, but you understand everything else.
Does the reversion?
The principles.
The reversion is over here, yes.
That's 253, which is
Like you understand.
Just given to you up above.
oh, it's not like a cap rate.
Nope.
Your balance sheet. Every element.
See right here?
So you're setting it for from
Pretty
the
easy
other
to,
sheet.
dominate the rest of it. If you know how better control.
Basically, the balance.
Okay.
Is king.
Balance sheet and cash flow statement. The income statement is nothing.
All right, we got it finally? Okay, all right, so here's what we need to do. So, question on the quiz would be something like this. All right, so if you change one of the assumptions, so let's just go up here,
Let's test it, let's see.
all right? We've got a growth rate for our rents of 2.465%. All right, so what if we were to change that to 5%? Okay, so let's see what the flow-through effect is going to be. The flow-through effect is only going to impact our basically net present value over here of 34, now be $34.87. So with a 5% growth rate in rents, first of all, check to make sure that your rent payment line matches up all the way across. If it does, then at least you got that part correct, okay? And then if you got that correct and you've done everything else correct, then it should flow through now to your net present value over here of being 34.87. Okay, so if you match with that, with making that one change with a 5% growth rate in rents, then you should have 34.87. Your spreadsheet is probably okay. Okay?
I'm good.
If you didn't get that, you did something wrong. Okay? Now,
Just 5%.
take a look at that for a second. So, what was it? Instead of being 34, it was what? 28? Is that right?
2805.
Yeah, 2805 was what it originally was. So basically by increasing the rents, that is saying that you're spending that much more on basically occupying or renting that property. Therefore, it's becoming less of a good deal than it was, which only makes intuitive sense. Okay? What if we raise it a little bit higher? Let's say we go to 10%. Not a little bit higher, a lot higher. Okay, 10% every year your rent goes up. Okay, that would be the ideal scenario for a landlord. How would you love to charge people 10% more a year? Okay, so in that case, yeah, your rent's jumping up dramatically. Now all of a sudden your NPV, 51 bucks, okay, or 51 million versus 40 million for owning the property. So now all of a sudden, somewhere between 5% growth rate in rents and a 10% growth rate in rents, we have crossed over to where now it is more advantageous to own than it is to rent. Does that make sense? Okay. Now, for those of you that are really sharp and you're reading between the lines, the question on the quiz is probably going to be, at what percent are they equal? No, where the NPV of renting is the same as the NPV of owning. So those of you who want to go ahead and solve for that, you figure out what percent will make that happen. And that's going to be quiz question number, whatever it is, 6 or 7.
Can we use goal seed?
We solve it.
You can do whatever you want to. All I want's a number.
People go seek us too.
Okay.
For which one?
All right, let's finish this thing up. All right. A couple of other quick things.
Oh, basically.
All right, a couple of other topics for the quiz. What are synthetic leases? And I will give you 10 points on your quiz to name the company, it's not in your book, but name the company that was most famous for using synthetic leases. Not, you can't Google it. If you do Google it, you're disqualified.
Enron. Simon.
Enron. What? Yep. Enron is the most famous company ever for using synthetic leases. Okay? So what are they?
Using a special purpose entity to...
A single purpose entity or special purpose entity to create this whole illusion of ownership and debt. Yeah. So basically, let's kind of walk through sort of an example. Okay. Good friends at Enron. You know, it's kind of interesting, the quick little story. Obviously, Texas-based company. Whenever I was teaching at Texas A&M back in the late 90s, I had a bunch of students that were real estate students that went to work for Enron, okay? And what was fascinating was back then, I mean, if you've ever watched the movie The Smartest Guys in the Room or whatever, is a movie based on Enron, you need to watch that, actually. It's a great movie. But anyway, I remember back then that we would send these students, these master students in real estate, to go work for Enron, and you would ask them, so what does Enron do? And the response that you usually got back was, well, we can't really talk about it. And, you know, and I always thought that was just really weird, you know, at that particular point in time. And, you know, it was like, well, yeah, there's some energy trading stuff that they're doing, and, you know, there's, you know, this other stuff that they're involved in, but it was all kind of energy related kind of things. And, but, you know, really didn't have a grasp of what they did. And then all of a sudden everything eventually blew up and fell apart. And one of the biggest reasons that they sort of fell apart was their overusage of what were referred to as synthetic leases. Leases that are leases but not really leases. That's the term. Okay? So think of it like this. Basically, we've got a parent company that has several subsidiaries. Company A, Company B, Company C. All right? And each of these companies, like the parent company would be like Enron, so to speak. All right? But each of these other sort of subsidiary companies would be a company in their own right, but ultimately would kind of, you know, be owned or have an association with Enron or the parent company in some way. But here's what was happening. These individual companies would go out and potentially buy property or lease property, and let's say they would lease, I don't know, $100 million property, all right? And, or let's just say they bought it. That'd probably be easier. Okay, $100 million property, they bought it. And they took out debt on the property of whatever, let's say 90 million debt. What they would do is they would use sort of the creditworthiness to a certain extent of the parent company in order to get a loan, but they wouldn't really disclose that the parent the debt on the parent company's balance sheet. Okay? Think of it like this. This is probably the easiest way to explain it. And that's why I use the word parent. Think if you're, okay, think for example, if I'm a parent and I've got 3 kids, okay, 3 subsidiaries, all right? And I've got excellent credit, but my 3 kids are all losers, okay? And the 3 kids, I am willing to co-sign some loans for them, all right? And so I co-sign one loan for a car loan, one maybe for a home loan, one for some other sort of loan, all right? But I don't really disclose fully that on my credit that I have co-signed for those loans. So in other words, it's really not being run off of my credit, it's sort of being run off of their credit, but yet I'm a backup, okay? So if something goes bad, it's gonna come back to me, but if nothing goes bad, then in essence, the kids are sort of on their own to make their payments and so forth. Does that make sense? Okay, so the synthetic lease part is that basically these guys here are potentially buying property and then leasing it back to me, maybe at below market cost or in some way that I am not showing any sort of long-term obligation on that property on my balance sheets. So in other words, it shows that I'm leasing the property, but I'm not really owning it or have the debt associated with it, but my subsidiary has the debt associated with it, but it's not transparent that I am really on the hook for it ultimately, but from an accounting perspective, I'm not. Does that make sense? Thus is the why, shortly after the whole Enron debacle, we had this whole new change of regulations called Sarbanes-Oxley. Okay, if you've heard of that, okay? Basically, the pretty much says you've got to start disclosing that whenever you start, in essence, co-signing, this is like for companies, when you start co-signing these notes, you've got to disclose that on your own balance sheets. Instead of just a teeny little footnote, it needs to be something much more substantial so that it shows that you actually have more financial obligations than you were previously disclosing. Does that make sense? So it's kind of like, I mean, a simple way of looking at it. Let's say that, you know, I can borrow up to, let's say $1 million to keep things, the numbers nice and round. I already maybe have, let's say, $500,000 in debt. That leaves me with $500,000 of open debt to be able to use, or credit to be able to use, yes? But if I've got, you know, kid number one here that's got $250,000 of debt that basically they're co-signing for, if it were to be shown on my balance sheet, that would subtract from the amount of available debt that I have. But by him getting the loan and me just being sort of a co-signer without it really showing up anywhere, my credit's not being used. Does that make sense? Okay.
So you can't do that in the one?
No. So, or at least not to the point of where, yeah, it's going to be not disclosed. So the point is that they were doing this, which is basically allowing them to borrow almost infinite amounts of money.
So they just kept borrowing it through different leases?
They would just start over every time.
Right. Through different entities. And through the use of these sort of synthetic leases, we're able to basically hide the fact that they actually had this debt, okay, on their balance sheets. So the purpose, if you will, of these synthetic leases would be to, in essence, sort of not disclose or hide, basically, debt that you actually had or financial obligations that you had. Okay, does that make sense? Yep.
Do both those companies disclose the full amount on their balance sheets, or do they divide it into?
Well, so this one may, you know, be disclosing, but it's a question of how much of that. It's sort of like, is this company standing on its own? But it's really not standing on its own because it's really getting credit from these guys. Mm-hmm. That's the problem. It's sort of it looks like they're standing on their own, but they're really not. Right. They wouldn't be able to get the loans without these guys basically co-signing, or leasing in this case, whatever property it is that they have. Which could be, it's not just real estate they were leasing, it could be equipment that they were leasing, you know, other things, you know, associated with, well, basically, once again, being able to generate funds and then ultimately figure out a creative way to hide the fact that you've got all that debt. Because think about, you know, in other terms, like the circumstance of like a CVS or a Walgreens, in many cases, what they do, as we've talked about before, is they will go out, buy the land, develop the land, and then ultimately sell off the property only to lease it back. And the reason they do that is to free up space on their balance sheet to incur more debt. Because now all they have is this lease payment. But what Enron was doing was, in essence, you know, really selling it off maybe to this third-party asset, or you know, in some way, really keeping it on the balance sheets where they were never really selling it, other than to maybe one of these entities that would ultimately hold it, and then they were still responsible for it. But what would happen, or what did happen, is that whenever it blew up financially, in the sense that the asset, they were no longer able to service the debt, then all these individual components blew up, and then the whole parent company blew up as well, because they can no longer afford it.
So now when you go to a lender, they'll ask you what all your entities and kind of treat them as holistically, right?
Yeah, that's, I mean, exactly. And which is what they should have done all along. But the imperfect nature of how sometimes things are set up, that somebody gets really creative and figures out a way to skirt the system. And in this case, that's what they were doing. This should have never happened, but it did.
It's not uncommon to do LLCs per project. Right?
No, yeah, I mean, actually, but the reason why you have single purpose entities or special purpose entities is almost always because you're trying to isolate the legal liability.
Right.
So, and also in the event that if one does blow up in some way, that it doesn't affect the others. So, you know, almost always when you see real estate owned in, you know, several different, you know, ownership structures, so that you'll have, you know, okay, this is property A, and it's owned, you know, as property A. This is property B, it's owned as property B, and, you know, basically a separate ownership structure for each one that rolls up into potentially, some sort of a parent company or whatever. But hopefully the idea is that if something happens on that property, it's not going to affect the other properties in the portfolio. Okay, moving forward. But you really need to watch that movie. Smartest guys in the room, fascinating movie.
So the answer to that question would be artificial leases.
It's like hiding ownership in debt.
Hiding ownership.
Okay. All right. Another question in terms of how long should you lease, and more specifically, shorter leases versus longer leases. So, in your opinion,
Longer.
well, I haven't got there yet. So, in terms of, from a tenant's perspective, let's just start with the tenant's perspective. Are you better off doing short leases or longer leases, and what are the kind of the pros and cons of each? Okay, if you do it, let's start with, I'm a tenant, I do short leases, what is the value of that for me? Okay, easy exit.
Just like exposure to changing market conditions.
Okay, you're going to be much more exposed to market changes up or down, okay, in terms of rental rates. Okay, what else?
Irregular, consistent payments, because your payments are going to change every year.
Well, yeah, depending on how short the lease is. I mean, we're not necessarily talking about going from, a 30-year lease down to a 1-year lease, but, maybe we're saying, okay, maybe going from a 10-year lease down to a 5-year lease or something like that. So what other sort of benefits would I have as a tenant?
Subject to renegotiation usually.
Okay, then maybe you could, once again, renegotiate once again. If the market is changing favorably in your direction, what else? Okay.
Ability to move.
More paperwork.
The ability to move, obviously, much more quickly.
Yeah.
But on the flip side of that, the downside of having short-term leases is what?
Escalation in cost.
The rent is higher.
High rent payments.
Okay, well, yeah, short-term leases, downside is going to be rents are probably going to be higher because the landlord is saying, okay, yeah, you're not going to be leasing as long. I'm incurring risk of you being able to move out sooner. So therefore, I'm going to charge you a higher rent. Okay, what else?
Whenever you renew, you'll be subject to an escalation.
Okay, yeah, you're going to have, well, you're going to, yeah, okay, with the short term, yeah, you're going to be potentially subject to a huge escalation. Okay, but everybody's missing one point that I'm surprised you're missing.
Add-on costs as well.
Such as?
So if you move, you have to pay for moving.
Yes, okay, the frictional cost of moving that of having to, relocate your office, and that's not,
Commissions as well.
that's not like inherently just a simple thing. I mean, all of you that have moved just your personal location, you know how much of a pain that can be of just, not just a physical move, but, changing your mail, changing your phone service, electrical service, all that sort of stuff. But, imagine that on a much larger scale, that if you're, a corporate office or you're a retail chain, you're whatever, and you start making those kinds of shifts, it's a, hugely expensive,
TI work.
Transaction. Well, I'm sorry?
TI work.
Yeah, and all the 10 improvements that you're going to have to do to make the new space ready, so, it's not without its cost, okay? All right? So what about on the landlord's perspective? Short-term versus long-term. I mean, obviously kind of the reverse of the tenant, but I mean, anything there?
I think we're just talking about the tenant improvement, if they do something.
Yeah, if you do something for a tenant, that maybe you pay as the landlord for a 5-year tenant, and then they move out after 5 years and you get a new tenant, you're going to have to redo it all over again, versus if it's a 10 or 15-year tenant, you're not going to feel quite as bad about having made that investment in many cases, okay? What else?
The cash flow of the landlord is now shortened by
Right.
that period of time.
So what type of tenants, if you were a property owner, what would probably be the longest term tenant or the type of tenant that you could probably get in a space? Government.
No.
Simple answer, okay? Because in many cases, they want to lock down whatever property it is that they're going to be in for, in some cases, 30-year leases, okay? you know, and you know, and they can pretty easily do that. Whereas, you know, most business tenants, I mean, yeah, they may lock in 10, 15, 20 years for some types of properties, but probably the most standard is going to be 5 to 10 years. Because they don't even know if they're going to be in business, you know, in some cases, or the same level of business, you know, 10 years from now.
Well, they also have the ability to move from state to state, county to county, where a government.
Yeah, you're sort of fixed in location.
Miami-Dade can't go.
Yeah. We're gonna put the Florida transportation or whatever folks up in Mississippi. Yeah, that'd work out well. Okay. All right. What else for the quizzy? I think we're almost there.
Did we look in the spreadsheet of, is that a manual thing to make them the same, or?
You got it, yeah. Okay, so what are some of the assumptions? These are sort of, what are some of the assumptions that it would be better to own a property as a corporate owner than to lease it? Okay, one more time. What are some of the assumptions that it would be better to own a property than to lease it?
You could always sublet.
I mean, in other words, what would be one of the overriding factors that would
Appreciation in the value.
okay, value appreciation. So, if in other words, you get the choice. I want to, as a corporate owner or corporate entity, you either want to buy it or you want to lease it. Okay. So one of the things that would really drive your decision to want to buy would be you anticipate the value of the property going up dramatically, you know, over the time that you're going to occupy it. Okay? That seems like a very logical thing, but that would be one of the things that potentially would drive you, because that would imply that maybe at some point in the future that property's going to be worth a lot. But it's interesting to sort of, because, well, a couple of reasons actually. One, because it's going to be worth more, but what if you're not going to sell it? Why would you care?
Cash out
Building
refinance.
equity.
Well, okay, you're building equity, but if you're not going to sell, it's like a corporate
Tax
headquarters.
shield.
I'm sorry?
Tax shield.
Okay, but I think you're missing yet another one.
It's a cash flow element.
No, okay. You bought the property, you've chosen to buy the property, and the reason you chose to buy it as opposed to lease it is because you are convinced it's going to go up dramatically in value over time. And I'm asking, assuming you're not planning on selling it anytime soon, why would you want to buy it as opposed to lease it?
Controlling costs, you don't have to worry about outflows.
Okay?
Well, you don't have to worry about paying rent payments.
Yeah, okay. More specifically, you don't have to worry about the property owner raising the rent.
Yeah.
Okay? Because what could very well happen is, let's say you're there for 5 years paying your normal lease payment, and then at the end of the 5 years, you knew the property was going to go up in value, but at the end of that 5 years, you're kicking yourself because you knew it was going to go up, and now the landlord takes advantage of that and says, hey, the property's worth double what it was when I initially leased it to you, therefore your rent's double. Okay? So you would have been much better off leasing the property, avoiding, obviously, that rental increase. Does that make sense?
Yes.
Okay. Now, at some point, you may determine that the real estate itself, and this happens quite often, especially in all sorts of businesses that have over time kind of deteriorated in value in some way, that the real estate may become worth more than the business itself. I mean, think about like retailers that maybe have owned, like, take like a Sears.
Macy's.
You know, but, you know, like Sears at one point was, you know, the #1 retailer in the country, you know, owned a lot of real estate, owned many of the pad sites that they occupy, okay? And, you know, over the past 25, 30 years, you know, they've been in a fairly steady state or accelerated sort of decline where, I mean, how many of you within the past, let's just say 20 years, have shopped in a Sears? Okay.
Okay, you've been to
Okay, auto center. Okay, excluding the auto center, you know. But my point being is, it's not a very popular retailer for the most part in terms of. I'm sorry, what?
I bought a grill 4 years ago.
Okay.
But even Kmart, so that's a more popular brand than
I
Sears.
don't
Right.
think so live out for me.
But my point is, you know, it's a retailer that's in decline. It owns a lot of real estate. It's probably worth more dead than alive.
Yep.
In terms of the real estate. That's my point. And there are many businesses that's the case. That, you know, it's like you're better off selling off the real estate, pocketing the money, giving it to the shareholders, your investors, than just continuing to allow this slow death in, you know, the retail environment. Now, of course, they can use all sorts of arguments and try to say, well, we're trying to keep the company alive for our employees and this and that and the other thing. But those employees probably aren't doing anything. You know, they're standing around with no customers.
Yep.
You know, what kind of business model is that? That doesn't make any sense. I mean, you can say, well, we're trying to be loyal to our... No, at some point you've got to say, enough is enough. It's time to move on and realize we are a failure, you know, in this sort of business climate, and, you know, sell off and do something else.
Eddie Lampers has been using it as a cash cow, because he's been using credit.
The credit card.
Right.
That's what
Well,
you're
no,
saying.
not the credit. He's just been issuing out debt
Right.
in the sense of bonds. And
Yeah, I would love to know who the idiots are that are buying those, because it just,
You and me both.
you know, it just doesn't make any sense to me. I mean, because there's just no future there, unless there's some sort of magic, you know, that we don't know about, that where they're secretly converting Sears into some sort of Amazon type of entity, which is not happening.
I have to look at the financials.
So, anyway, comment, question?
No, I was just saying two things. One, I was there about 2 months ago, and there were like 3 employees in the whole place,
Yeah.
which kind of, you know, shocked me because they still had some amount of inventory. And there was also something in the news about the chairman, CEO of Sears wanting to buy the company,
Right.
and he offered them like $4 billion, and they turned him down. I'm like, they should have just give it to him. I'm throwing a couple stores for free.
Yeah, but that was the pension holders at the time,
Yep.
because he already has debt in the company that he's issued.
Okay, I think we're almost there. Oh yeah, one last little thing, and then we'll have time for the quizzing. Okay, something we've already talked about, but I thought I'd throw it on here again. Our good friend, the loss factor. Okay, you may remember that from back earlier in the semester. All right, so what is the loss factor? Basically, remember we have gross square feet, and we have sort of leasable square feet. Or usable, okay? But leasable, usable, what do we want to call it, all right? All right? So, if we have gross square feet of, let's say, 100,000, and we have a loss factor of, let's say, 20%, that means that we would basically have 80,000 square feet of usable square foot. Does that make sense? Now, do you remember what the loss factor was? In other words,
Cat space?
sort of not common area maintenance space, but
But like the pillars sticking out.
yeah, it's basically all of the things that take up space in a property that's not usable. So everything from walls to elevator shafts to basically utility rooms to, you know, things that you're not going to be able to lease out and actually use for the normal productive kind of use of the tenant. Does that make sense? So in this case, the loss factor, we have 100,000 gross square feet and a loss factor of 20%. That leaves us with 80,000 square feet of usable space. Now, if I were to ask a question, or were to say, all right, the amount we can charge on leasable square feet is, let's say, $30 per square foot per year for leasable space how much money are we losing because of the loss factor?
Well, wouldn't it be 20% additional?
Yes.
Yeah.
So in other words, you're basically, you'd be saying, all right, we're losing 20% or 20,000 square feet, yes? So 20,000 square feet
600,000.
would be the loss per year due to basically this loss factor. Does that make sense? So the lesson within that is this is basically the context the book was using it is all about building efficiency, okay? And that, think of it like this. How many times have you walked into office buildings, especially ones that were built in the 1980s at the height of sort of crazy opulence and that sort of thing, where you had these massive, massive, unusable, but there sort of lobbies.
Huge.
Yeah.
With all that old marble and.
Yeah, and,
They
you know,
mentioned that in the book about owning versus buying with the company. Like, the CEO's got the big ego and wants to have a big lobby
right.
and wants to live, be close to where he lives.
Absolutely. But, the point being is, those lobbies were massive. I mean, you go into some of these buildings, and whether it's, in New York or Miami, Dallas, wherever, and, some of these lobbies are just absolutely massive. And there's spaces that can never really be used for anything productive. I mean, maybe you can put a Christmas tree there during the holiday season or something like that, but they're probably not set up well for events or anything. But anyway, they're wasted space, putting it bluntly. So now the question becomes, kind of from a building efficiency or building design point of view, to what extent do you try as a developer, try as an investor to acquire properties that have as low of a loss factor as possible so that you really are getting to lease out the overwhelming majority of the space for productive rent-bearing activity. Does that make sense? Okay. And so, in one sense, you could sort of say, okay, we have building A and building B, they're identical in terms of their gross square footage, but this one has a higher loss factor than this one. How does that really translate into the revenue that it can generate and ultimately its value? Yep.
I see that in a lot of residential buildings like Enrico, for example. I see that across the board with the luxury,
right.
Buildings there. Do they compensate the loss factor with the higher price that they put into?
Yeah, a lot of it is. I mean, so try to understand what I'm saying in terms of just pure efficiency. You want a lower loss factor. But yet, there are many things that are emotion-driven, perception-driven, and which are much more obviously difficult to put a number on. And some people do appreciate those so much that they're willing to pay more to occupy that space because it does have the big pretentious lobby or fountains or whatever it is. So I'm not saying those things are worthless. What I'm saying is that, from an investment point of view, all other things kind of being equal, how much do those really drive the underlying rents and the value of the property?
They did that a lot of those, let's say for example, like Brickell City Center mitigates this factor by having WeWorks there. That's part of the strategy.
Partially, yeah. And the whole WeWorks thing is kind of falling apart. I mean, I honestly thought I find it okay. Qualify the statement. I like the idea of sort of short-term office space rentals for smaller companies and that sort of thing, and making it easier for those people to lease space because in many cases they do fail and fail maybe quickly. And so for them to lease, even engage in a year-long or a 5-year lease just doesn't make any sense. But for them to, try their business out for a few months to see if it works or not, I think those spaces make a lot of sense. But I really think they carried the concept a bit too far, clearly, and overexpanded and thought there was a much higher demand for that kind of space than what there really was in reality. And I think everybody kind of jumped on that same bandwagon of saying, woo, let's all develop and invest in these short-term sort of office space rental, and I think they just oversaturated the market and overestimated the demand for those kind of workers. Because I think there's, the other aspect, I mean, I understand the value of having the office space, because, yeah, those people do want a professional setting to be able to meet their clients in and so forth, as opposed to having to go to a coffee shop or their house or, wherever. So I get that, but at the same time, one has to sort of say, well, is it really something that many businesses fall into that sort of a model to necessitate that?
And a lot of, I saw that a lot of big companies, kind of follow, or they wanted to get into that model, like Microsoft, for example. They have a whole floor. They're in Millico, which is, a $7 billion company in telecommunications. They have a whole floor too. So I think they try to, sell the idea to those big companies as well, but it's just didn't.
Yeah, I think that part of it, and this is not like a new concept. I mean, I remember the beginnings of this concept of what was called office hoteling.
Office hoteling.
Began probably in the mid-90s, and it was the whole idea, and accounting firms were like at the very forefront of this at the time, that they were basically saying, okay, we've got all these accountants, many of which are constantly in the field working with clients, at their offices and whatever, and they're really very seldom back at the home office. So what do? We basically set up our home office as an office hotel where if they have to use the home office, they come in, they've got like a little locker, they pull out their stuff, go, if they're meeting with a client, they get a nice corner office with a big view and table and whatever. And it was kind of the beginnings of all of that. And the whole idea was to save, and they were saving a lot of money on office space for those people, because if you think about it, like a cubicle, is like 8 foot by 8 foot, and then by the time you add perimeter walk, you're sure like 10 by 10, so you're like 100 square feet per person. Well, if you've got a 10 by 10 space for every single employee, as I said, that's 100 square feet per employee, and if your rent in a lot of these office buildings is, let's say, $50 a square foot, you do that math, and then all of a sudden you're saying, okay, wait a second, for each employee, yeah, that's $5,000 a year. And then I've got 1,000 employees.
No. 5.5 million, 500,000.
So that's $5 million a year in real estate costs for my company. And if I can go to an office hoteling concept where I only have to have space for just, let's just say, half of these people, then all of a sudden I've cut my real estate cost by $2.5 million down to $2.5 million. And then use that savings for whatever other, things I want to use it for. But once again, make me more competitive than, whoever my competitors are. And so it's not really a new concept. It's just kind of a repackaging and rethinking of how do we utilize that. But to try to develop partnerships with corporations like WeWorks or some variation of that being kind of the entity that sort of can absorb the management of all of this and just sort of say, okay, that if you're one of my employees, I'm Microsoft or whoever, that you got access to a WeWork facility, and so you just sort of check in like you would at a gym or wherever, and you're there for X number of hours. Well, then they automatically bill the parent company those hours and call it a day. So it's not in theory, not a bad concept. It's just a question of, yeah, how much demand really was there, is there, will there be, you know, as we sort of move forward with that. Okay. All right. Other questions, comments, observations? Yep.
Just go over one size enough at all.
I think that one was just. Yeah, that was the whole thing about why is it better to own? The reasons for that.
It's worth more.
Yeah. Okay. All right. So let's do this before we take the quizzy. One thing we want to do, I sent you another spreadsheet that we're going to take a look at next week. Okay. So I sent it to you yesterday. It's an after-tax cash flow model. Okay. And we're going to kind of walk through that next week. But what I want you to do, let me see if I can pull it up here real quick. Okay. This is what it looks like. All right. I want you to take a look at this model. I want you to play with it prior to coming into class next week. And we are going to probably have a few quiz questions related to this model. We're going to go over it. We're going to explain kind of how it all works and that sort of thing. But the extent to which you can spend some time with it between now and next Saturday would be a good thing. Okay? Do you hear me on that? Yes? Okay. So spend some time with it before next week. All right? And it's a fairly simple model to understand. And what it does is it tends to integrate most everything we've done for the semester. That's kind of the purpose of going over it, is to sort of say, okay, now I see how all this fits together in terms of a lot of these different component parts. So, you know, spend some time taking a look at it, seeing kind of how it operates, and then we'll talk about it next week. Okay? Yep.
Course review or whatever.
The what?
I got an email. The class.
Okay, course evaluations?
Yeah.
Okay, we're going to do that right now. Okay, that's before the quiz. All right. So basically, I'm going to give you about 15 minutes. We'll start the quiz at 11 o'clock. So you got an email probably last week about course evaluations. You need to do those. And if you want to do my course evaluation and also go ahead and get the one done if you're doing the law class, you can do that one as well. But I want you to do those, because one of the things, and I'm just going to say this because it's true, the most important part of the course evaluations is not just the numerical numbers that you put down, but what you write about the course, what you say about the course. You can say whatever you want to say. I don't care. But I want you to obviously speak the truth, you know, about whatever you have to say, but what went well, what didn't go well, what you appreciated, maybe what you didn't appreciate, what you think, you know, can be done to improve, you know, all that sort of stuff is fair game. But all of that is useful feedback. We do look at it. We do take it seriously in terms of using it to get a sense of where do we go from here, okay? And so make sure you do those. Go ahead and do them now. I'm going to get out of the room for a few minutes, but I'm going to give you until 11 o'clock to do the course evaluation for this course. You can also, as I said, if you're enrolled in the law course, you can do that one as well. But here's the thing. If you don't do it today, it's not going to be available tomorrow. The deadline is today.
The deadline is today.
Yes.
Can we do it after class, or?
I would say do it now, get it over with. Okay? Yep.
Could you put back on the sheet? I just wanted to compare my numbers to make sure I do the right one. Close.
And I tried to equate the two, and I ended up like a 50% or something like that. Am I in the wrong?
Yeah, I didn't understand that part.
Did you change it?
Was the growth rate 2.645?
465.
Or 465? Okay. All right.
And then what was the part about quitting?
The net present value of renting is equal to the sum. What's the discount rate? But you're changing the discount rate, right? Find what is worth when they're equal.
You have to change
Okay. Got it? So I can unplug it, move on.
They're both at net present value.
Could you scroll down a little bit? Those numbers stay the same?
Yeah, nothing in the very bottom is going to change because that's.
Did you find this one here? And that's going to 53 points.
That's the sell price, which is getting right there.
So I did this.
Right here. Yep. Yep. That's it. You may have not made enough zeros.
I didn't because I was trying to flirt. I didn't understand what you were changing.
The only thing that you're going to be asked to change is the growth rate on rent. Right. Yep, those two numbers. Okay, shutting it down.
You have to go through each formula and click enter, so it changes.
What's the mitigating factor? Why you can't just finagle? Oh.
Okay, once again, you've got until 11 o'clock to finish up the course evaluation, and then I'll come back in, do the quiz.
No. His finance class.
Oh, in his class.
I think last time.
Bring it up.
Oh, we received extra credit for that. If we all did it.
Oh, you mean last semester?
Last semester.
That's because I didn't have you all in one space. And you guys have done so well this semester, I need to give you an extra credit.
This is actually 10 points for that end run, so I'll tell you that. So I'm going to need that extra 10 points for my end run.
The discount rate, what do you have? You discount it. You guys never heard of that?
End run by company end run?
No. They got creative. Makes sense. I would. People like, well, you know, the soul have to go. I would never done that. I would.
It was, you know,
It's
so
a
then they couldn't do it.
We fucking barely have it.
They probably like,
Same with the housing market.
yeah.
What was the Wolf of Wall Street amount?
Cocaine and
Yeah,
drugs.
he was.
Yeah,
He was a salesman, that's what he sold. He sold himself. I'm the man, I'm the salesman, you buy whatever I tell you to buy.
so it's something.
He got a
So go
I mean, well, where it was basically, yeah, they would like.
Okay, whenever you're done with your course evaluation, you can pick up a quiz. But don't do it until you finish your course evaluation.
We're not being incentivized.
Was a quiz?
Oh, what's that? Everybody get 100.
You know those 21.45? No, I got it. So what you did is,